third quarter of 2022 continued the downtrend in global financial markets that had occurred in the first half. High inflation numbers were the key catalyst for the decline in markets, leading to the US Federal Reserve raising rates by 75 basis points in their July meeting and a further 75 basis points in September. This is the fastest rate hiking cycle in history, 300 basis points increase in 7 months, with the Federal Reserve shifting from a transitory inflation narrative to a more concerning narrative. The MSCI index rallied through the first half of the quarter until the Jackson Hole Symposium in late August, when Federal Reserve Chair Jerome Powell reiterated the Fed's overarching focus right now is to bring inflation back to our 2% goal, and he warned that this will cause some pain to households and businesses. While we had initially looked to get more constructive markets in July on the back of peaking long-term interest rates, events did not pan out as we had hoped, and we reversed course through August and September. From a fund perspective over the September quarter, the Munro Global Growth Fund, our long-short strategy, returned a positive 2.7%. Our capital preservation tools being very effective with positive contributions from each of hedging, shorts and foreign exchange. The Munro Concentrated Global Growth Fund, our long-only strategy, returned a positive 1.3%, minus 4.3% from equities and positive 5.6% from currency. Finally, the Munro Climate Change Leaders Fund, our climate thematic, returned a positive 8.8% in the September quarter. Climate stocks with US business units were given a boost by the recently announced US Inflation Reduction Act, or IRA, which we see as a game changer for the decarbonisation of the US. Global equity markets continue to be in a bear market. Having experience in bear markets, we continue to stick to our mantra that discipline needs to outweigh conviction. This is what our risk management and stop-loss processes were created for, and we have relied on them heavily through this period. We have flagged for some time now the 3 things we're looking for to help identify the end of this bear market. Firstly, long-term interest rates to peak. Persistently high inflation data, increasingly hawkish rhetoric from Fed President Jerome Powell, and 3 75 basis point rate hikes have seen long-term interest rates back up to touch 4% in September. While interest rates might have peaked now at 4%, the higher interest rates for longer will also likely lead to a more protracted economic slowdown. Secondly, earnings estimates to come down. Higher interest rates have caused havoc to valuation multiples throughout 2022. However, we have only just started to see the economic damage that high rates will do. Earnings estimates have only come off marginally for 2022, and analysts still expect 8% earnings growth in 2023 for the S&P 500. This seems highly unlikely. Lower earnings estimates will eventually lay that foundation from which the market can sustainably recover. And lastly, time. The average bear market lasts just over 300 days and falls 37%. And if history is any guide, it pays to be patient in this environment. We continue to be wary of further exogenous shocks that could be precipitated by the higher interest rate environment. Longer term, the sun will shine again. It always does. As time passes, the Fed will regain control of inflation, interest rates will peak, and the economy will bottom. Across our portfolios, we own large cap stocks with fortress balance sheets. Longer term, we know that these companies are positioned to benefit from some of the most important structural changes occurring in the world, and hence remain confident that these companies can grow through the current uncertainties. We remain excited about the opportunities presenting themselves out of this current bear market and are simply attempting to remain prudent, disciplined and patient in what is a difficult time for markets.